Let's take the conversation forward with Karan Taurani, Senior Vice President at Delectable Capital, and Bhavin Shah, Founder and Portfolio Manager with Samiksha Capital. Karan, what are you telling your clients? There are two ways to look at the Zomato IPO. First, IPO pop, and second, 3 years out. Let's discuss both the sets. For those who are planning for the IPO pop, will they get something? And for those who have a patience to sit through it for 2-3 years, will they make money?
Right. So I think the first part in terms of the IPO pop, which is largely the listing gain part in the near term, I think there's not too much, for the near term investors to make at, because the valuations are already at a very big premium, versus the global peers. And that is, entire growth drivers, in terms of India demographic story, smartphone penetration, increased user base in tier 2 and tier 3, increased frequency of calculates into a growth of about 25 to 30%, which largely factors in this premium valuation. So there's not too much to draw at this $8.5 billion market cap, which they are coming at. But if you look at from a medium to long term perspective, I think definitely, there is a potential for a re-rating. There is a potential, for things working favorably. But that all depends in terms of how the execution happens. So I think there are 2 or 3 major risks which I would allude to. And if these risks were to work favorably, for Zomato, then I think there is a good amount of money to be made from a 5-year horizon. The first part here is, of a third new entrant coming in the market. So Amazon, as you know, has been testing waters. And if a last player like Amazon comes in, and if, they resort to a high cash burn and, go for the market very aggressively, then there could be some kind of lower growth rates for Zomato. So that's one risk which is there. The second risk, I believe, is on the execution of the new business initiatives. So be it the delivery or be it the backward integration, what they're doing in terms of, supplying the raw material to the restaurants. Those are businesses which are highly fragmented, even the grocery for that matter. So those are businesses which are highly fragmented, higher cash burn. So how things turn around on that is, is a monitorable. The third, in my view, is the discount. So during the pandemic, you saw the discounts coming down, and that was primarily because of the dining frequency coming down and people were forced to order more. Once things move to normal, this audience can actually go to dine in frequently as they were in terms of pre-COVID, and that could actually increase the discount. So to increase the frequency, you have to kind of push discounting, and that impacts your profitability. So I think these 3 factors, one will need to watch out in terms of how things move in the medium to long term.
You valued the traditional IT services companies. Those are cash flow machines. Those are companies which do buybacks and sit on surplus cash. Here's a different proposition. Is it time to look through the excitement which is there for the Zomato IPO and consider this excitement as an opportunity?
So I think if you look at the traditional IT services versus the internet companies, there's a vast difference in terms of growth rate. There is also a difference in terms of the profitability metrics. There is a big difference in terms of... Sorry.
Karan, go ahead with your view. Apologies for that audio leak.
So if you look at the traditional IT services company versus the internet companies, there are 2 different things here. Traditional IT services are not growing, sub 10% kind of growth rates. These internet companies are very promising, and they've got a growth rate of almost 25-30% at least on a base case. And if the business proposition is good, if the execution is good, and if things go their way, they can even surpass 40% kind of growth rate. So that's the opportunity which we're looking at. And of course, profitability is something which one would not look, right now, because it's still very early days. If you look at the smartphone user base, if you look at the penetration story in India, we are still talking of very low numbers, versus global other countries globally. So I think profitability will come once you reach a certain scale. These businesses have just evolved 5 to 7 years back. there will be a profit for sure, but that all depends in terms of how the order frequency comes in, how the market structure shapes up in terms of no new player coming in, whether the market remains to be a duopoly or not. So it will depend on all these factors put together.
Sure. So, Karan, just an extension to the point that you're making, we understand the pros and cons, but for the retail janta, all it comes to is whether they should be subscribing at the price band of 72 to 76 or not, or wait, be in the wait and watch mode. Agree for those, looking at a listing pop. That's, of course, a separate segment altogether. But for the slightly long-haul investors, is this the right pricing that they should be subscribing to the IPO or not?
Yes, definitely. As I said, for the long-haul investors, this is the premium pricing, but definitely we have a subscribe rating, on the IPO, and we believe that in the medium to long term, if things work favorably, there is a good amount of return possible on this company.
Bhavin, just wanted to understand from you, given that there is no direct comparable to any peers in the Indian market, how are you stacking Zomato up vis-a-vis some of its global peers and the valuation that it's commanding at present?
So I think, Zomato has much smaller in revenues compared to the players in US, Europe, England or China, and yet the revenue multiple that the IPO is coming out at is significantly higher. So that just doesn't make any sense. And I think, the way evaluation journey of a company works is that when it's a small company, when the revenues are small, the benefits of scale haven't yet come through, are not proven yet. So market gives a lower multiple. When those things are proven, company achieves scale, profitability, the multiples can expand, and obviously you can participate in the growth of the company as well in that journey. Here, the whole thing is loaded up front. And there is this sharp increase in valuation in last, compared to the last round. Public market investors are being asked to pay, I don't know exact number, but 70% premium or something like that, for no good reason. Because the company, obviously, caveat of COVID, but if anything, during some periods of COVID, there was obviously there should have been more demand for delivery because restaurants were closed for dine-in. So despite all that, we don't see that strong revenue traction. In fact, I think they tried. It seems like they tried to improve the profitability or show better profitability before IPO. In that process, they lost revenue traction. So it is yet to be proven whether this company can deliver both growth in revenues as well as improvement in profitability. And yet we are pricing it way above anything else in the market in the world. So that, I think, is a serious issue from a valuation standpoint.
So then, to pose the same question that we did to Karan, what would be your advice to the retail investors at a time like this, looking at all of these dynamics, the overall financial picture, the fact that it's in a category of its own, the valuation metric as well? What's your take?
Well, I would, if I were to give an advice, I would say wait. If there is some listing pop that you're counting on, that's a risky game to play to begin with, given where it is being priced at. But you could probably, one could play that game. But beyond that, it's best to wait. The company is going to have a lot of cash because of this IPO. So if the stock price falls materially, then suddenly, you're getting a company with a lot of cash on the books at a very, much higher percentage of market cap in cash. So that could be the interesting proposition at some point. And we also have to see how they use this cash, because if you look at Zomato's history, they have tried many things, and a lot of things they have kind of withdrawn. Like 2 years ago, I remember the story was that Zomato is going to be the global player in food delivery. And, today, look at it, they have been unsuccessful in every country outside India. And now they just recently put in $100 million in a grocery business. taking a stake in a company. I mean, I don't know. Today we have some really good alternatives for buying groceries. I don't know whether that move will succeed or not. So I think there is a lot of question marks in my mind. So unless somebody really has a much better clarity on these things and knows what they're doing, I would stay away.
Karan, what would be some of the major negatives that you think investors have to contend with? Apart from the overall financials, what do you believe are some of the other list of negatives?
As I said, the list of negatives are, the trends moving against them once things move to normalcy. If you look at the order values, they moved up by almost 40%, and that was primarily because of a lot of the orders being called from premium restaurants. I think that is going to be a big monitorable in terms of how the order value moves in the next 2 to 3 years. And the second negative, of course, is in terms of the profitability aspect, because if you clearly see, right now the metro cities in terms of penetration are somewhat plateauing, right? We've reached almost 60-70% penetration in the metro cities as far as the customer base is concerned. I think to drive the order frequency, you have to push discounts, and that could have a significant negative impact in terms of profitability. So I think these are two trends or, two things which could kind of work against them once the situation normalizes.
All right. And Karan, if you were just to give us a sense as to what the Zomato IPO means as a precursor for some of the other much anticipated tech, internet, new age IPOs.
So I think a lot of the the various aspects which go into giving a certain multiple or to any particular company depends on various aspects. One is you can probably benchmark it to the global peers. You can check the scale. You can obviously check the market structure in terms of how many players are there in the market. You can also check in terms of the profitability aspect of the company. So I think these 4-5 factors will be very important to arrive at a target multiple. If you look at some of the listed names today as well, in the likes of Affle, InfoEdge, all these kind of companies, they trade at a huge premium in terms of EV sales basis, but that's justified. I mean, if you look at InfoEdge for that matter, they are the incumbents in the Naukri business. I mean, the threat of new competition is very, very low out there. If you look at something like an Affle, they are doing premium growth rates with good, healthy margins as well. That's why they've got the premium multiple. So I think a lot will go in terms of how the market structure is, what is the kind of growth, and what is the kind of profitability.
Bhavin, how are you looking at the entire food delivery market in India? Because the view is that as of now, it is fairly underpenetrated and that there's a lot of scope and potential.
Yeah, I mean, I think if it is fair to say that there will be a lot of potential in the smaller cities, eventually. But at what tickets and all that, business model things that we want us to still work out. And I think there is a temptation to compare with places like China. But let's be clear that India is at the $2,000 per GDP per capita. China is at 10,000. If you do an extrapolation and assume 6-7% GDP, real GDP growth, it will take another at least 25 years for India to reach that China's GDP per capita. So one has to be, and the interesting thing about some of the precursors for food delivery are already in place. So in other words, the service is available. People have data connection on their phones and other ways. So it is not like there is a lot of under-penetration from that standpoint. So I mean, I think food delivery market is a real market. I mean, it will grow, and I think there is no question about it. But it is not one should not assume that we are going to catch up with the kind of revenues that are there in China in next 5 years or 10 years. It will take a lot longer. So that is something to keep in mind. And other thing to keep in mind is also that I think the competition is not yet settled, right? There are players like Dunzo who obviously are there. Restaurants obviously are trying to, especially the premium restaurants, are trying to go direct to consumer. And smart consumers know that they can order it cheaper by ordering directly with the restaurant. So all those factors will also be at play. So I think one has to keep that in mind when looking at the overall market.
Right. Thanks very much then, Bhavin, as well as Karan, for joining in and breaking down and assessing the overall metrics, pros and cons, and as well as your final verdict on the Zomato IPO, much awaited.